So, look, yeah, I'll kick things off. So, yeah, welcome everyone to today's workshop, and hope everyone's obviously keeping safe. Bit of housekeeping before we get started. In terms of agenda, Tom West, who's the founder of Hyper, who a lot of you have probably met, will begin by discussing the investment cycle, who to raise from, the investor do's and don'ts, and how to allocate your seed round. And then our second speaker, who's Simon Moynagh from Icon. Icon's a global tech investment firm. He'll discuss the Series A investments and beyond, and also how the pandemic has affected the investment world. Simon, do you want to give a bit of a background, quick intro, if you will?
Yeah, no, absolutely. Good to meet everyone, and hello, and thanks very much for inviting me on the panel, Matt and Tom. So I'm one of the partners at Icon Corporate Finance, and we advise companies in the tech sector either on raising capital for growth, or when it's exits, we advise the shareholders when they come to sell. So we are very active at sort of raising kind of the Series A and Series B capital, and also doing recapitalizations. And on the exits front, we sell typically to strategic acquirers. So we've sold companies to the likes of Thomson Reuters, Aviva, RWE, Empower, Accenture, NTT, Telstra. So it's very much a sort of global buyer base that we deal with, and there's certainly a trend from big, large kind of multinational firms like Telstra, like the NTTs, who just can't kind of develop technology in-house, and so they're kind of spending kind of large sums of money to buy it on the market and acquire it on the market. And those are companies often which are pretty small relative to their size. So they're often kind of, maybe only kind of 30 people, but they're happy to spend kind of large sums of money, which therefore in turn is fueling kind of this wave of capital, which is going into sort of early stage venture capital money. And the amount of money that's been raised to fund technology companies is kind of never been higher. So it is probably kind of one of the best times to be an entrepreneur if you're looking to raise money. So that's a kind of bit of intro on me and on Icon. I hope that's okay for you, Matt and Tom.
Yeah, perfect. Thanks, Simon. So everyone, at the end, we'll have about 20 minutes for Q&As. There should be a Q&A button at the bottom, so just click that and type in your question. But yeah, over to you, Tom.
Awesome. Thanks, Matt. And thanks everyone for jumping on Zoom this morning for the UK, and good evening for the Aussie founders, and I suppose afternoon for the UAE and Saudi Arabia. So the first thing I want to chat about is, I suppose, the 5 phases of raising capital. And as Simon mentioned, he specialises in Series A and beyond. But today I just wanted to take you through this simple diagram of the first round of capital you typically look to raise is from friends and family. So they'll typically chip in 5 to 10,000 at a time. And that pre-seed round is usually the round that gets your MVP live in the App Store and starting to transact and process some transaction volume. And then moving on is a seed round. And that's typically angel investors that have a larger check size of, say, 50 to 100,000. And then Series A is usually once you've proven your business model, you've got some transaction volume, and you need that capital to scale into new cities or new countries, for instance. And again, Series B is a larger raise, and that's usually a few other countries, and you're starting to land grab and get that first mover advantage. And then there's even Series C, D, and on, and then getting on the stock market, and acquisition, a merger. So I'll just break down each section. So family and friends, believe it or not, for Amazon, for instance, Jeff Bezos, the first round of investment he raised was from his parents. Uber, Travis, the first round of investment he raised was $10,000 from a friend. So that pre-seed round is typically the friends and family, and they are showing support. They're doing little due diligence. They're not going to add a huge amount of strategic value like a VC does, or an angel investor that may have owned a successful business, but they are taking a lot of risk because you haven't proven your business model yet. Now, the angel investors, as I just mentioned, they typically They will do a little bit more due diligence and family and friends, but they do have that larger check size. They do typically come with a bit of strategic advice. They may have already run a successful business, so they can add that value if you're a first-time founder. They typically have a good network, so it does come in handy if you can get an angel investor around the pre-seed, but usually it comes in around the seed round. Now, venture capital, VCs, there are a few cons. You do need to be careful. There are VCs out there that want you to sign term sheets that aren't in your favor. They can be aggressive, but they can also be super valuable. They can add a huge amount of knowledge, resource, network. They may have invested in similar businesses. They already understand how to scale the business. And they have that amazing network. And like I said before, the check size is a lot bigger than typically family and friends and angel investors. It starts to say around 500,000 into the millions, and that can obviously help you rapidly expand. Now, crowdfunding around the seed, sometimes pre-seed to the Series A, it can be really beneficial. Some of you in the UK probably would have seen Revolut. There is millions you can raise on crowdfunding, and if you're raising for a B2C technology business, it can be really beneficial because you're potentially acquiring tens of thousands of users at the same time, which reduces your customer acquisition cost. One good example for a hyper client was Sheba, female-only Uber in Australia. They actually raised around 3 million Australian dollars. And all of a sudden, they had thousands of loyal drivers that were now not only shareholders, but loyal drivers are never going to go across to, say, Uber as a competitor. So it blocks out that competition. And they also acquired tens of thousands of customers, which in turn saves millions of dollars in customer acquisition costs sometimes. For Australian founders, Equitize is our equity crowdfunding partner. And in the UK, it's Crowdcube and Seedrs. Some of you probably saw the news a few days ago, Crowdcube and Seedrs are merging. Both of them have raised around £1 billion since inception. They're now merging, so their database is going to be huge. The capital that they're able to raise for early stage founders is going to be significant. So that's pretty exciting for the UK. Now, government grants, it can be quite tedious, but it's definitely worth looking at the government grants websites, on a monthly basis. In particular, now they're deploying a lot of money. For instance, about bounce back loans, very, very little due diligence. If you can prove that you were doing revenue last financial year, they can give you an interest-free loan. You do have to pay it back, but it's interest-free for the first 12 months. There's also, in Australia, I understand in the last few days, they're releasing a new government grant that will give 10,000 Australian dollars per employee for the first 12 years to try to kickstart the economy post COVID-19. And in the UK, the Kickstart scheme is launching, and the UK government will fund any employees from 16 to 24 years old, 100% of their salary for the first 6 months. You do need to hire 30 people. So you're actually allowed to go to multiple startups. Your founders get together and hire those 30 people together. That can obviously save a lot of money if you're not able to raise hundreds of thousands of pounds. It obviously is quite valuable. Now, how do I find investors? This is obviously early on. What I usually like to say is, as I mentioned, personal, family and friends, network, friends of friends. There's a huge amount of online communities. If you want to jump on Eventbrite and Meetup, both of them constantly have capital raising workshops, angel investor workshops. LinkedIn's a great one. Crunchbase, some of you that are clients have probably seen that we've got a premium Crunchbase account. You can actually export active investors and get them all into a list, categorize them correctly too, from angel investors to VCs to family and friends. Angel list, it's worth creating a profile as well. Moving on to preparation. So do your background research is a massive one. When you meet an investor for the first time, you want to already know what was their previous business, what have they invested in. You want to know as much about them as possible. That's going to really help you quickly build rapport and respect with an investor. Make sure you have a data room set up, for the UK. It's really important, and I see a lot of early stage founders failing here. And it's really simple. You create a Dropbox folder or a Google Drive folder. You upload everything you want an investor to be able to view, whether it be your pitch deck, your prototype, your business plan, your financial forecast. If you've already raised a little bit of money, your cap table, that needs to sit and always be updated. And when you have a meeting with an investor, you literally need to share that with them within 1 to 2 hours. I see founders meeting with an investor saying they'll send information over and it takes them 7 days. By that 7 days, you've lost that investor. They're looking at a lot of investments, a lot of founders. And if you take 7 days to send information over to them, you can pretty much wipe that investment. So definitely make sure that you're organized with that data. Now, the pitch, one of the things you really want to make sure you've closed is partnerships. It's key to launching successfully and getting some rapid traction. Don't ask for an NDA. And I know a lot of you probably think, that's a bit crazy, but 99.9% of the time, these investors, especially these early investors, they're not going to be meeting with your competition. They're not going to be investing in your competition. If you feel they are, then that's fine. You might ask for an NDA, but otherwise, don't worry about it. It's a privilege to meet with an investor, for them to take time to give you some mentorship, some advice. So don't worry about that NDA. Make sure you know your numbers as well. So some of you have probably seen Shark Tank and Dragon's Den. If you don't know your numbers, you can get yourself in a lot of trouble. You need to know what your projected forecast revenue is, your profitability, the cost of development, the cost of marketing, the cost to scale to a new country. So before you meet with an investor, just pitch this and get even a family friend or someone at Hyper to listen and critique and ask you those questions around the numbers, because you need to make sure you get them right. Now, next one is, how much should I raise? And the answer is as much as you need to reach profitability. That being said, most tech companies don't become profitable for 5 to 10 years. So it's how long's a piece of string? I usually like to say as much money as possible, because one of the main risks of an early stage startup is running out of money. I like to also say always be raising. So if you raise £50,000, investor the following week says that they'd like to invest, immediately organize that for them. Don't hold them off and say, I'll come back to you in a few months. Always be raising throughout that, for the whole journey of running the tech startup. It's one thing I see startups making that mistake is only opening rounds every 12 months. But if an investor is keen to invest, you need to take that investment as quickly as possible. Now, how do I deploy the money? It's a difficult one, and it really does vary. I like to give two examples. Two of our clients, Ride, which is an electric scooter company, versus Shiba, which is a female-only Uber. So you can see here with the pie chart, we've gone 30% development, 30% salaries. You obviously need to pay yourself a salary. You can't live on nothing. 30% on marketing. Now, Ride, for instance, we didn't have to spend any money on marketing. Why? Because the scooters sat out on the street. They were bright yellow and they just stick out so well that we didn't have to spend any money. And people would just see the scooter. They would come up, they'd scan their phone, the QR code, and they would transact. Whereas Shiba was a bit different. We had to probably spend about 27% on marketing, because we needed to acquire those drivers and customers, and being a two-sided marketplace, we needed to spend that accordingly to make sure it balanced out correctly. Equity as well. So pre-seed, I think 5%, 10% to friends and family. The seed round around 10 to 20%. And I always like to say it's a lot better having a small piece of a big pie than a big piece of a small pie. If you can own 40% of the business after 10 years when you're IPOing on the stock market or your company's getting acquired, you're going to be in a very good position. So don't hold on to that equity. The investors are taking a huge punt on you. There is a lot of risk involved, so do give them that equity early on. And that's me done. I'm going to now hand you over to Simon to chat a little bit more about Series A and beyond. If you guys can see the Q&A, you can ask as many questions as you want. Just press the Q&A button, and after Simon's had a bit of a chat, we'll be able to go over those questions with you. So thanks, guys.
Good, thanks very much. And I'll start my bit talking about the sort of Series A and beyond.
Awesome. Sorry to jump in, Simon. I've just stopped sharing my video, so I think you can probably now press the
start video. Okay, I'll see how I can do this.
Is there a share video button?
Yeah. I've clicking start video, and it says you can't start your video because the host has stopped it. So
don't worry.
I don't know why that's the case. Let me just try one more time. That's not working. The video. I'm sorry. You just have to hear my.
Yeah, unfortunately, we're not going to be able
dulcet town.
So all good. That's just
that's fine, Tom. Look, so if I just start off, I'll talk kind of on two topics. Firstly, kind of what investors look for at the Series A and beyond stage, and then talking about like the funding process, as in the kind of various stages that you have to execute on to kind of successfully raise capital. So those are the two kind of topics that I'll cover. So the first one is kind of what investors look for. And some of this actually Tom's already covered. You need to have sort of IP and barriers to entry. Investors are looking for that. They want to see a quality management team, and the importance of that management team and the quality of that management team increases the earlier stage you are. So the earlier you are in the company's life, and if an institutional investor is coming on board, they'll really want to take comfort in the management team, because that's really all there is at these early stage companies. That it is just the people, and so the earlier the company, the more important that management team are. And they're also looking for a large addressable market. So the things that they are looking for are sort of IP barriers to entry, quality management team, and a large addressable market. But those actually aren't the most important. What's kind of even more important than those three is traction and growth, and that's what sort of set these companies apart. That's where you see these sort of super high valuations, lots of money going into sort of companies which have only been around 12, 24 months, and the reason is yes, they may have some of that IP, they may have good management team and the addressable market, but it's the growth which really gets investors going. And that's what kind of has the biggest chance of getting you noticed, getting you a success, and overcomes all manner of problems. If you've got the growth, that covers up all manners of other issues that you may have. And I remember being on with a client and stepping into an investor pitch, and the CEO said, look, 2 months ago we're doing £30,000 of revenue a month. We're now doing £30,000 of revenue a day. And suddenly, everyone's eyes just lit up. You had everyone's attention, and that's kind of the most important thing. And if you talk about growth, as I said, that's kind of what gets investors most excited. In terms of the sort of returns that investors are looking at the Series A and beyond, well, if we go back to sort of seed stage, typically at the seed stage, investors are probably looking for 10x, 10 times their money back is where they'll be at on a seed round. So they need to see a plan which delivers them 10 times their money. When you're at a Series A, it's quite a spread. I'd say it's sort of anything from 5 to 10 times their money back. That's kind of cash on cash they want to receive. So every £1 million they invest, they would want to get 5 million or 10 million back. And then when you're at Series B, it's still quite punchy, but more modest compared to the seed and Series A. And I'd say it's sort of more the 4 or 5 times returns. And then when you're sort of beyond Series B, and it's more, like a sort of, I suppose, private equity type transactions, they'll be typically looking to sort of double their money or triple their money. And so the sort of, obviously, the more advanced the company, the later it all is on the life, the less risk there is for the investors coming in, and so therefore they're not looking for such a high rate of return. And conversely, at the earlier stage, there's massive of risk, and they need to really sort of have returns or see potential for returns which kind of compensate them for that risk. So that's kind of where broadly what investors are looking for. And then I'll just talk a bit about the funding process, and this is some funding process that we would run if we were kind of acting for kind of a growth stage tech company who was looking to raise kind of money from institutional VC investors. So there's kind of three broad stages that we talk about. There's the preparation stage, then there's the go-to-market stage, and then there's the closing stage. In terms of timeframes for that, we would say if you're doing that sort of raise, you typically need to allow anything from 5 to 6 months. So it isn't a kind of quick, it's not a quick process. It is something that, we would say kind of budget for 5 to 6 months. It can certainly be done quicker. We've seen it done quicker, but I would say typically that would be the time to allow, and it's the closing stage which does take up more time because they're institutional investors. Their bar and their requirement for diligence is much higher than you'd see at an earlier stage. But if we just talk about the preparation stage and what needs to be done at that stage, and I said this could be done pretty quickly, and we can get companies ready to market in as little as 2 weeks. The preparation stage is you need to agree your financial plan. And the financial plan is probably the kind of most important piece because it needs to show that level of growth to give investors a return. So we're talking about a kind of level of growth where if it's a Series A, 5 to 10 times their money back. So they need to see how that company is going to hit those numbers, so that when it comes to sale or future follow-on round, which allows them to cash out, they're going to be able to get their money, get that sort of return. So that kind of financial plan is really important, and it's something that will get scrutinized. It needs to be bottom up, based on how many, from the cost side, how your staff, who you're employing, how you're deploying those marketing budgets, and then in terms of the revenue, where that revenue comes in. So that's kind of quite a granular bottom-up plan, which would get a lot of scrutiny. The other things that you need to prepare is then that investor deck, and that'll be quite similar to what's already been covered by Tom earlier on the series on the seed investor deck. It's typically around 20 slides. And then also as part of that preparation stage is the virtual data room, which Tom's mentioned, where you're putting in all your legal contracts, all your key kind of employment contracts, and having that kind of ready and set up will certainly kind of help you in that closing phase. And then the third thing you need to then do is decide who you're going to approach, and drawing up the investor list of who you're going to approach. And so that's kind of what you need to do at the prep stage. And as I said, that can be done pretty quickly, especially a lot of companies already have the financial plan in place, and so we can be out to market pretty quickly. We're then into the sort of, I suppose, go-to-market stage, and that's when you start making those approaches to investors. And typically what we would say is when we're running a process, we'd approach investors with a sort of 2-page summary of the business, so it's sort of teaser, and on the back of that, they would then decide whether they wanted to sort of progress to see the full investor deck and have a meeting with the entrepreneur and the technology company. And those meetings would be typically kind of anything from sort of 40 minutes to an hour and a half. As I said, they can run over if investors really like it, and they can sort of clear their diary. But typically, you need to be kind of covering your material on a pitch deck within sort of 40 minutes, allowing for questions as well. So So that's kind of part of that. And then you'll be having follow-up meetings with investors as they bring in other members of the team to sort of assess it, and it needs to go through an investment committee. And then you'll be sort of trying to get term sheets from those investors. And the idea is that you want a number of term sheets landing at a similar time, and then you're using that competitive tension of competing term sheets to really kind of push your valuation, get the best deal structure, and then you're into that stage where you're then selecting your preferred investor that you, or it could be investors. If it's a syndicate of a number of investors, you're then selecting your preferred investor to then say, like, yeah, we want to close this deal with this party. And you think then it's all done, but unfortunately there's still quite a lot of work to be done. One of the things the investors will ask for is exclusivity. So they want to make sure that you don't speak to anyone else during this time. And that exclusivity will be typically sort of 2 to 3 months. And this is when the sort of, I suppose, the nasty part of the transaction kind of really kicks in, and it's the due diligence part of the transaction, where they'll be appointing lawyers and accountants to really sort of check that the company is making the claims, that the claims that are made by the company do stack up. So it is an inherently negative process, and it's one that kind of does kind of wear people down, and the lawyers love asking questions. And and the preparation work that we talked about preparing a virtual data room early on, the better shape that's in, the more prepared you are for that, will really kind of help smooth that closing process. The other thing which is happening in parallel with due diligence is the legal contracts, and that is where the formal kind of long form legal contracts are being drawn up. So that's the sort of terms at which the investor is kind of going to be a shareholder in the company. So as well as obviously putting in cash, they'll also want to have sort of various protections for their minority stake, and it'll cover things like kind of positions on the board. And there's various sort of details that need to be covered off. And again, there's a negotiation that goes alongside those legal documents. And so again, that needs to be kind of done. And ideally, if you can do that in parallel with the due diligence, it will kind of shorten that closing time frame. So it is a sort of full-on process to kind of bring in institutional money. They take it very seriously, but the kind of the upside is that you're getting kind of larger chunks of money. You know, typically Series A investors will want to invest at least sort of £1 million, £2 million to go through that sort of level of work. So it does mean that you have then got a well-capitalized company to sort of progress and hit your targets. So I'll probably kind of pause there, see if there's any questions, Tom.
Yeah, no, brilliant. That was some amazing insights. Thank you so much, Simon. So yeah, we have quite a few questions. I think, why don't we start with Andrew Matthews? He's chatting about pre-revenue business. Could you speak to your recommendations and the advantages of the following fundraising options for your initial capital? Bootstrapping with all your savings. So I don't know about you, Simon, but my advice would be raise capital and keep all your savings as backup. One of the big issues with an early stage business is, and one of the threats is running out of money. So if you can raise capital and keep your savings as backup, I think that's the best advice. If you can't raise capital, you might need to use some of that money, some of your savings to bootstrap, and you are going to get a higher valuation once you've bootstrapped and spent that money on getting the MVP live and getting a little bit of traction, because your valuation is going to go from, say, 1 million to 5, but it is a risky period. So my advice would be hold on to your savings and try to raise first. Would you agree, Simon?
Yeah, no, I think if you can raise money certainly. And I think as well, it sort of probably comes back down to a bit about the plan that you're trying to execute on, and I think about sort of cutting your cloth accordingly. So don't start sort of spending kind of hundreds of thousands of pounds on salaries when you're sort of bootstrapping it yourself. You've got to really sort of get people on board with a similar mindset. You may have to give up a bit of equity to do that. So it is at that earlier stage, until you've got that proof of kind of revenue traction, you really have to sort of really kind of watch the pounds and watch the pennies, and really sort of kind of get through that proof point yourself, really. And so you've got to cut your cloth accordingly. So I wouldn't be, if I was sort of starting up a company now, I wouldn't be sort of overexposing myself personally. and if that means sort of bringing in a partner or friends and family around to help you, but they've got to really believe in you. But it is quite a sort of unique situation, those, and each kind of startup journey is like a novel. It's got its own story of how they did it, and there's not sort of one size fits all. So I think you got to sort of assess it on a case by case, and someone in their 20s is going to approaching it's going to look very different to someone in their 30s, and likewise someone in their sort of late 40s who's probably got a bit more sort of capital behind them is going to have a very different approach. So it is quite personal how people kind of choose to make that step.
Yeah, definitely. And the second question was from Andrew, was friends and family round. What funding structure do you recommend? Convertible note, debt with modest interest rate, or all equity? Really depends on the family member, I think. And I would probably say equity, just hand over, whether it be 2.5%, 5%. Early on, if you're taking on debt, the future investors are kind of going to have a look at that, and it might be a bit of a warning sign. So I would probably just say equity. Would you agree, Simon?
Yeah, I think at these stages you don't want to have it complicated. It's a risky investment. People want equity exposure. You're not going to be able to support debt at that early stage.
Yeah, I mean, if it's a parent that kind of doesn't expect the money back, you might have a little side agreement with them. But I think equity. And angel investor, with this, what funding structure do you recommend? Do you know answer that, Simon?
Yeah, I would still say equity. You want to be keeping it simple, keeping it clean. I think the key is the dilution for the founder and the entrepreneur, who doesn't want to sort of take too much dilution, and it's kind of trying to find a valuation which works at those stages, because you don't have traditional financial metrics to base a valuation on. You can't base it on a profit multiple because you're probably not profitable. Obviously turnover multiples are sort of more common now for tech companies, but again, that may not give you the right number. So it is sort of a negotiation and a discussion about kind of what both sides are comfortable with. Certainly, that early stage, you don't want to be giving up more than sort of 20% to an angel investor for that first round. Otherwise, by the time you come to your Series A or your Series B, you're going to have so little equity in the game. It's going to make it hard work for all that personal risk you've taken to build the company. So it is a judgment call, but definitely you don't want to give too much equity away. But I don't think the stage of the company supports a structure akin to debt. So it is sort of it is equity, but not too much.
Yeah, exactly. And Ryan has a good question. You mentioned 10 to 20% equity to investors. Would you say it's better to offer 10% for a more silent partner and nearer to 20% for an investor with some ability to provide additional growth and strategy? So I usually like to say, I think you're right. If a strategic investor is going to give you 5 hours a week and start helping you in the business, you can give them a bit more equity. To someone that just says, here's your money, I'm too busy, I don't want to have anything to do with the business. You do need to set expectations though, because if they find out, one might feel like they're getting ripped off and be disgruntled and not going to give you money at a later date. So I think, you can adjust that amount of equity they get and adjust that valuation, but you just need to set expectations.
Yeah, no, I think it's probably worth saying that at an angel stage, I'll be looking to give away less equity. When it's a Series A, typically investors will be looking for probably at least 20%. 20 to 30% tends to be what you kind of see at that Series A. They want to have a decent exposure to the upside, so they'll be it's hard for them to sort of do less than 20%, or it sometimes happens. So that's kind of where it's at.
Yeah, brilliant. Another question directed at you, Simon. Simon mentioned quality management team as one of the requirements to successfully raise funds. When is a good time to hire people if you are yet to raise enough funds to pay salaries?
When is a good time to raise?
Yeah, I mean, my thought is, you want a quality team, obviously, as soon as possible. You need to be able to sell your vision, your mission, and you need to be able to try to get these early amazing quality team members over the line for maybe just equity without a salary. They might just be helping you part-time for the first 12 months. It might be a CTO that's getting paid £150,000 a year that, because you can't quit their job, you don't have that money to pay them yet, but you're happy to give them, say, 5 or 10% vesting over 4 years, for instance. So they have to prove their worth. And you just need to outline that you haven't raised the funds yet. You'd love to have them on board. You're happy to give them some equity, but they'll be getting a paid a salary once you get closer to Series A and you have enough funds to start paying everyone some half decent salaries.
Yeah, no, I think that's fair, and it's unlikely that if you're early stage, you'll be able to go in the market and just sort of hire the best management team. You're just not, you're not going to be able to get a VP from Google to come and join you unless you know them personally or there's some other connection. So it is sort of using your networks, people that you worked for before, and sort of getting them to come on board, and almost whether it's sort of their kind of co-founders with you, or like Tom said, kind of giving them some equity to sort of get them on board, and or share options is a way to sweeten it to get them on board, because you're not going to be able to afford to get them otherwise.
Yeah, exactly. Another question from Anonymous. Early in the presentation, I think Tom mentioned that the pre-seed would typically be a raise of under 20,000. Then before the seed round, there would be an MVP and start getting some traction. My question is, what if the development of the application would cost at least 50? So, I mean, when I mentioned pre-seed, small round, that can be from 10 to 50 to 100, the more the merrier. It really also with the MVP, it depends. If it is going to cost you 50,000, you can, and you haven't raised 50,000, you can look at other alternatives. For instance, cutting in an engineer. If you cut in an engineer, if you only raise £20,000, but you cut in an engineer, you might spend some money on design work, but that engineer that you've cut into the business will build that MVP over a 3 to 6 month period. You're not going to need that 50. So it really depends, how much you raise. Development, obviously, if you're using an agency, it can be pricey. If you find an engineer, it can cost nothing. So really, depending on how much you raise, you need to weigh that up. I think I always like to say, as soon as you start working on an idea, start meeting engineers. Engineers, if you don't have that engineering skill or ability, they're going to be really important when building a tech company. So start jumping on networking events, start meeting engineers, try to find that engineer that they might just work part-time in the beginning and full-time after 6 months. But raise as much as money pre-seed, but we typically see around 20 to 40 being raised, and then based on whether you have an engineer or not is how much it's going to cost you to develop. Now, let's find another question. Andrew Matthews, on the friends and family equity round, how much room do you have in terms of valuation? I mean, is there a max cap of the valuation that you really can really push, say 1 million, especially if it's pre-revenue? Yeah, I mean, it's very difficult to value a business when you're pre-revenue. Investors are really only looking at the team and the idea and the market size. But again, coming back to friends and family, I think it's more about how much equity do you feel comfortable giving your friends and family? They're taking a lot of risk. I think around the 500,000 to 1 million valuation is fair for your family members. If you do have a gigantic partnership over the line, you've got the ex-CTO of Telstra, you're going to be able to, that amazing team and scalable idea, you're probably going to be able to push that valuation up a bit. But I think you really need to look after your family members and give them at least 5 or 10%, up to say 15 or 20. But keeping in mind, as Simon said, around Series A, the VCs are going to want 20 to 30%. So just keep that in mind. Ryan, to account for startup costs as per your pie chart, I'm looking at raising £300,000. If I'm offering 10% equity, which values the company at 3 million, is that feasible? Yes, I think I mean, if you're pre-revenue, I don't think you should be. 300,000 is amazing. If you have friends and family that are happy to put in 300,000, I've seen it a lot happen, but it's not. It's a little bit rare. I really think that pre-seed, you probably want to start looking at raising a little bit less, getting the MVP live, the valuation down a little bit, say 1 to 1.5, and then just raising 200 to equal 300 a little bit further down when you've actually got the MVP live, you've proven the business, you've got a little bit of transaction volume. That's going to allow you to maybe get the valuation to 3, 4, 5. Go for 300, but I like to always say start with 5. I see founders trying to raise 250, 300 after 6 months. They're struggling. They haven't been able to find that investor that wants to take that huge risk in a pre-revenue company. So start with raising £5,000. Understand how your data room looks, how the legals look, how the term sheet for an investor looks, creating the cap table. Start with raising 5, 10, and get that experience of raising capital for a startup, and then start looking at raising larger check sizes. The founders pre-seed, I see raising the quickest, fastest, easiest. They start small. They might raise 5,000 off 10 people, 15 people. If you look at Uber, for instance, he raised, I would say, $10,000 off about 20 people. All of those investors took a huge risk. Their equity is now worth $10 million plus. They got amazing returns, crazy returns. But yeah, he started small. Same as Amazon. He started a few friends and family. Family then put in, I think, 120,000. He then went and raised $1 million, and no VC backed him. Jeff went and got, I think, 50,000 off 20 people. So keep that in mind until you like that large 300, 400, 500 million. It's really usually comes in when you've got this amazing team and you've got you've proven the business. You've got some transaction volume coming in. Let's have a look for some more questions. Pancake, the Kickstarter, is that the Are you referring to Kickstarter crowdfunding? Do you want to just rewrite that question? I'm a little bit confused over that one. Okay, and last, Andrew Matthews, last question on debt versus equity. My previous debt question was assuming a bullet repayment of a future date. I was envisioning a friends and family arrangement that is cordial, friendly, raising from a wealthy 60-year-old, for example, and say, I will pay your money back when the big business is profitable, or pay you back in 5 years. Have you ever seen something like this before? I have, if it's especially an uncle or a grandpa, a wealthy friend, 60-year-old that you might know, that is really just gifting money. I think it's possible, but again, the future investors, the VC firms are going to look at, I think, the debt, and they're going to be a bit worried. When a business has debt that they have to pay off, it can be a bit of a concern. Simon, you've probably got a response for that as well.
Yeah, no, I think if there's a bullet payment in the future, that will make it really hard for certain VCs to come on board. It needs to, the business, when you're then speaking to investors or the VCs to raise capital, you'll need to have considerable traction elsewhere and have enough other good points kind of to overcome that quite large negative point on that bullet payment. Yeah.
And we'll pay your money back when the business is profitable. Like VCs, tech companies aren't typically profitable for a long time, and some investors understand and don't mind that. Uber, for instance, I think I mentioned before, they're not profitable. They're not going to be profitable for a while, but the market cap continues to go from 10 million, 100 million, billion, 2 billion, and all the investors' equity is skyrocketing and worth so much more. And they're land grabbing. They are scaling to new cities, new countries. They're acquiring 10,000 new drivers a week. They don't care about profitability. So saying that you pay it back when profitable, I think that the investor yeah, it's probably not going to get that payment for a long time. And as Simon said, the VCs will be a bit concerned there. Happy to have a call offline as well, Andrew, if you want to continue that discussion. We've got one more question. What's your advice on financial projections? Currently forecasting my cash flows and my revenues are highly dependent on how much I can grow my user base. My user base penetration is based on assumptions of market size and say capturing a very small percentage of the market whilst having an SEO marketing budget. Is there a better way? Let me get my head around that question.
Do you want me to jump in? Yeah. No, I think it's it sounds like the person who asked that question is going about it in the right way in terms of thinking bottom up, thinking about like the evidence to support your numbers. And so it's the sort of the detail that you're phrasing in there is exactly the sort of detail that will feed into your assumptions that drive your financial plan. So I think I feel from your question that you're kind of thinking along the right lines, and you just got to work it through methodically. And these financial plans, they do need that detail to be built up and bottom up, and that will show real kind of credibility when you speak to investors.
Brilliant. Okay, cool. I think one more question. What transaction volume is most likely to get a look in by investors from HP? So I suppose we need to know what type of investor, but let's say a VC around Series A. Simon, do you want to answer that?
So I'm trying to say, understand what it means. What transaction volume is most likely to get a look in by investors? What do you mean by transaction volume?
Yeah.
I think that's.
Well, let's say traction, like the business is doing 10,000 a month, and then all of a sudden does 60,000 the following month. Scalable, the VC gets excited.
I think if you're at the Series A raising capital, you want to be at least kind of at or close to getting to 1 million of recurring revenue a year, ARR. So I think that's MRR of about 80K. So I think you need to be kind of on that path to get there, or you need to be going to get there pretty quickly, or there already to really get to really get on that sort of Series A investor radar. Yeah.
And as Simon said, the monthly recurring revenue, if it's only going up 1%, if it's going up 20%, 50%, the higher, the quicker the VCs want to fight over investing. As he mentioned, there was a startup that was doing 30,000 a month, and then all of a sudden they came back and they're doing 30,000 a day, and that's when you're in a very, very strong position, and VCs are fighting to invest, and you can really basically take that investment on your terms, as opposed to begging for the money. Okay, fantastic. Well, I think that's all the questions we've got for now. We've been around an hour, so don't want to take up any more of anyone's time, but thank you so much for all attending. And Simon, thank you so much for joining the panel. It was absolutely amazing, fantastic insights, and I really appreciate it.
Thanks. No, thanks very much. Thanks for having me.
Awesome.
Thanks, Simon.
Okay.
Thanks,
cheerio.
guys. If anyone has any other questions, feel free to email Matt or myself, and we'll be happy to answer any further questions. Thanks so much, guys.
Okay. Bye-bye.
Bye-bye.